Every year, thousands of buyers attempt to purchase small businesses. Deals get negotiated, letters of intent get signed. Due diligence begins, and then, something happens. The numbers don't match expectations, the financing falls apart. Or the buyer suddenly realizes the business they thought they were buying doesn't actually exist in the way they imagined. Industry insiders estimate that more than half of small business acquisition attempts never close. Not because the buyers lack capital, and not because the sellers lack interest, but because the process of buying a business is far more complex than most people expect. Today we're going to break down why most deals collapse before the finish line, and what disciplined buyers do differently. The first reason deals fall apart is misunderstanding the financials. Small business financial statements rarely look like the clean spreadsheets you see in corporate finance. Owners often run legitimate personal expenses through the business. Family members may receive salaries. Vehicles, travel, and discretionary costs are sometimes blended with operational expenses. To evaluate the real profitability of a business, buyers must normalize the financial statements. This process determines true operating earnings. But inexperienced buyers often rely on seller-provided summaries instead of verifying the underlying data. Then during due diligence, bank statements, tax returns, or payroll records reveal a different reality. At that point, trust erodes, and the deal begins to collapse. The second major reason deals fall apart is deal structure. Most small business acquisitions are financed using a combination of buyer equity, seller financing, and bank loans. But if the structure is too aggressive, the business may not produce enough cash flow to support debt payments. For example, a buyer may attempt to finance nearly the entire purchase price with debt, or assume unrealistic growth projections. Lenders quickly identify these risks, and when financing cannot be secured, the deal dies. Experienced dealmakers design structures that preserve cash flow stability. Because a deal that looks good on paper can become disastrous if the business is starved of operating capital. The third reason deals collapse is operational risk. Some businesses appear profitable, but rely heavily on the owner's personal relationships or knowledge. If the owner leaves, customers may follow. Suppliers may renegotiate terms. Employees may reconsider their future. Buyers must evaluate whether the business can function without the current owner. Businesses with strong systems and stable demand tend to transition more successfully. But businesses built entirely around the owner often struggle during ownership changes. The final reason deals fall apart is due diligence. This stage verifies every assumption made during negotiations. Financial statements are compared against tax returns. Revenue patterns are examined. Equipment is inspected. Contracts are reviewed. Sometimes this process confirms everything is exactly as represented. But other times, significant issues emerge: undisclosed liabilities, deferred maintenance, or customer relationships far weaker than originally described. Disciplined buyers expect these possibilities and structure their acquisition processes accordingly. Buying a profitable business can be one of the most powerful wealth-building strategies available, but it requires discipline, understanding financial statements, designing sustainable deal structures, evaluating operational risk, and performing careful due diligence. The buyers who succeed in acquisitions are rarely the most aggressive. They are the most thoughtful. Because the goal is not simply to close a deal. The goal is to own a business that continues producing cash flow for years to come.